Now, welcome back, and in case you're joining us, many thanks. Of course, you're just in time for the big conversation here on KTN Prime in regards to the Finance Bill 2026, a bill that directly touches on you and I. That is the, of course, center of conversation right here in the country as we speak, even as the public participation in regards to that particular bill continues before the National Assembly Finance Committee. Now, how will you and I be affected by that particular bill? That, of course, is always, or rather comes about each and every year, even as Kenyans continue to decry the high cost of living and the high taxation by the President William Ruto-led administration. Now, joining me this particular evening to make sense of that particular bill is to my immediate right, Mr. Moses Ngugi, who is a tax partner at MGN Associates LLP. Thank you very much, sir, for making time. Also joining us this particular evening is Mr. Brian Onyango from ISPA. A very good evening to you, sir.
Good evening.
Also joining us this particular evening is Annette Nirima, who is a political accountability lead at Kenya Human Rights Commission. A very good evening to you.
Thank you and good evening.
Thank you. Last but not least is Mr. Daniel Murakaru, who is a legal fellow at the Institute of Public Finance. A very good evening to you, sir.
Good evening.
Ladies and gentlemen, many thanks for making time. Before we jump straight into this conversation, I want us to listen to the CS for Treasury, that is John Barry, in regards to what he had to say yesterday while defending certain provisions in the Finance Bill 2026.
Because I know he knows that is lying. Why would he lie to the people of Kenya that Finance Bill 2026 contains such a provision and it is not there? That is irresponsible. You bring the phone, there is no tax, there is no charges, there is no levy. But the time the phone is bought and is being activated is when you pay one single tax, that is excise duty at 25%. Tell me how that makes phones more expensive than the current arrangement. And anything new, and it is producing revenue and producing income, must also be subjected to tax in the spirit of fairness and equity.
For card payment fees, the bill proposes the expansion of professional fees.
Well, fair enough. That was CS John Barry yesterday in a press briefing right at the National Treasury offices. Mr. Ngugi, let me begin with you. Generally speaking, looking at the bill from where you sit today, if passed unchanged, what does it mean for Kenyans? How will it impact them to begin with?
Thank you, Ian, and viewers. It has both effects, positive and negative. Looking at the tax amnesty provisions, whereby those penalties, fines, and interest will be waived, meaning that will be cash flow to the businesses. Also, looking at the exemption on EV buses, that is electronic vehicles buses. Also, you have reduction in price of smartphones. So although there will be chances where businesses will have to make decisions and either expose stock because of reverse VAT, that has to be paid if some of those products become taxable or become exempt, rather.
Fair enough. Mr. Brian Onyango, let me come to you and let's talk about something very controversial now, something that has raised a bit of concern. And one of the proposals in that particular finance bill is, of course, the issue of moving the transport of sugarcane from factories from zero-rated to VAT exempt. Now, I don't know, from where you sit, first of all, because some of these terms might, of course, be easy for us sitting here, but for the Kenyan out there, some of them might not really understand what it means. So I don't know if you could probably lay bare for the common Kenyan out there what it means when you say zero-rated and VAT exempt.
All right, thank you so much, Ian. I think to start us off, it will be important for me to try to lay a foundation of what exactly this bill is meant to achieve, so that then we get to understand why some of those provisions are coming up. From where I sit, I think a finance bill is like a mirror. And it is like a mirror because it tries to reflect three things. Number one, it tries to reflect what the government values, all right? Number two is that the finance bill tries to reflect what the government fears. And the third reflection is that it tries to reflect who the government is willing to burden. So if you look at the finance bill from that perspective, then you start appreciating why some of these proposals are being put forward. But now to come back to your question, there is a general proposal in the finance bill that the sugar sector, for example, be moved from exempt from VAT exempt,
from zero rated
to exempt. And I think that is a very positive proposal in my view, because what it tries to do is that it tries to create an environment where the tax, in the sugar industry, for example, the consumer does not see the VAT per se, all right? But it is a double-edged sword, because on the back end, the producer is going to feel the cost of input as a result of that VAT that is being exempted now. So for me, it is progressive in the sense that the consumer will not see the VAT in the receipt, but it is also worrying in the sense that the producer is not going to claim input or the cost of the input.
There's concern, before I engage Annette, there's concern that this might lead to even the cost of sugar, for example, to begin with. Is that the case?
Yes, definitely, because the producers, the producers are going to roll over this cost to the consumer. So even though the consumers will not see direct effect of VAT, but indirectly, the cost of producing sugar will be higher, and this will have to be rolled over to the consumer at the end of the day.
Well, fair enough. Annette, let me come to you. I don't know whether you agree with Mr. Onyango, because he says it is a good proposal, but at the end of the day, Kenyans out there will have to pay more and part with more from their pocket to buy various commodities, because apart from the sugar itself, sugar is something that is used in various to produce other products. There's pharmaceuticals in it. There's animal feeds. If you're talking about issues like molasses. So from where you sit, do you agree with him that indeed that is a good proposal?
Perhaps before I respond to that, it would be good to lay a context,
okay,
and that then builds onto the conversation. And I think it's been observed widely that the finance bill of 2026 is geared towards widening the tax base, but also administrative reforms, And so with that understanding, you can already see what's playing out within the bill. And from a mwananchi's point of view, because a mwananchi would definitely be paying taxes, the bill is not about just tax collection. To the government, it's about broadening tax base, so that means the collection bit. But from mwananchi, it goes beyond tax collection to also just answer a simple question. Why am I paying more taxes and still struggling at the same time? And therefore, as we have this conversation that the new taxes proposed within the bill and also the amendments within the bill should be those ones that translate to mwananchi, quality education, for instance, lower cost of living, ensure that there's transport. I mean, last Monday we saw people walk. It should be the one that assures affordable health care. And so as we have this conversation, we are talking about the principles of taxation. To mwananchi, it's about the fairness, it's about dignity, it's about equity. So this bill then should be one that at the end of the day should ensure that there's not going to be a disproportionate burden on salaried people or Kenyans, and also low-income earners, but also then leaves out, for instance, wealth tax, for instance, that one that would leave out the large profits. So as we're having this conversation, and back to your question, to answer the difference between zero-rated and also exempt, and perhaps those ones that are provided in the bill right now.
Okay.
So there's one common thing between the zero-rated tax and also tax exempt. One is that it will not transfer VAT to the common mwananchi. But again, the difference is for the zero-rated goods, in this case, it means that the input, the expenses will be refunded back to the producer or the manufacturer at the end of the day. So that means that they will not transfer any more, or rather it will not transfer increase in terms of a product or goods that are being provided. But then when it comes to exempt, it means that the goods are not taxed, But now the only issue is there's no way a manufacturer will produce their goods but then fail to ensure that the price that they are putting on this product allows them to be able to attract a profit out of it. So having that understanding, there'll be a bit of a difference in terms of cost at the end of the day to the consumer that will be then transferred to the consumer when they purchase goods and services. And so those goods within the finance bill that have been transferred from zero rated to exempt will definitely attract higher cost.
Does that not then, overburden Kenyans more, because Kenyans are already crying about the high cost of living, and that will, definitely make it even more worse?
Absolutely, and so I think even as we have this conversation, it all depends with where you're coming from. For instance, somebody in the sugar business or sugar industry and perhaps are also using some of the products out of it will definitely be affected in terms of their production. And also that then affects the end user. But then there are those who would feel like, it's still okay because perhaps I'm not the consumer of this particular product. So it depends with where you're coming from. But definitely there is going to be an increase on the end user of these products. It may seem not like so, but that will be transferred at the end of the day.
Fair enough. Mr. Murakaru, even as we continue that conversation, first of all, we're seeking to finance a budget of about 4.8 trillion. Are we being over-ambitious? Because I remember at some point, I think 2 years after the head of state was sworn in, at that time he said the budget was, we're being over-ambitious and we should cut it a bit. But you're speaking about 4.8 trillion now. Are we being over-ambitious to begin with?
I believe on matters to do with our budgets and also matters to do with revenue, I think we're being over-ambitious in terms of the targets that we're setting, especially when it comes to matters to do with revenue targets. And the reason as to why, the budget keeps on rising in terms of matters to do with 4.8 trillion is because on one end, perhaps we are not spending on what we would call the priorities of the day in this regard, on matters to do with education, health, etc. But rather, we are seeing that there's some aspects where we are seeing matters on budgeting for corruption and budgeting for, high-end offices. And so this particular burden in terms of, having exorbitant targets on matters to do with our budgets leads then to missed revenue targets. And when we have missed revenue targets, then it ends up in this particular situation, which we have currently, where we have a finance bill, because at the end of the day, Kenyans must contribute to that particular tax basket to be able to meet this 4.8 trillion. And therefore, this then brings in this particular, I want to say it's kind of fatigue syndrome among the Kenyans, whereby they're feeling, why are we continually being asked to pay more taxes? Well, this 4.8 trillion budget that is being brought by the National Treasury is not really speaking to the lives of the people. And that's where the disconnect lies between us setting ambitious targets and ambitious budget ceilings, but at the end of the day, we cannot be able to sustain that high budget in and of itself. Yep.
You've mentioned something very interesting, budgeted corruption.
Yep.
Because the issue here is that many say the government has really focused on extraction as opposed to economic relief for Kenyans. And one of the key concerns is that despite the increased taxation, most of the time they don't see the value for the money being collected, and there's no proper accountability. The government at the end of the day spends or splashes billions, be it in events or travel. We saw the head of state the other day traveling to Azerbaijan and Kazakhstan, and there were concerns about even the cost of the private jet that was hired. And reports indicated that it costed over $500 million shillings. So at the end of the day, that is one key concern as well.
Absolutely. So if on one end, people cannot be able to access healthcare, they cannot be able to access education, but on this other end, we are seeing, high-end offices being able to spend on matters to do with, the jets, as you have said, then it creates that imbalance within the minds of the Kenyans. And I believe that's the reason as to why, despite the various issues which we can say there's a lot of misinformation and disinformation on matters to do with the finance bill, at the end of the day, the question that the common Wananchi is asking is, if then we raise those particular taxes, are they going to end up towards financing those particular jets, or are they going to end up, to finance some of these particular issues that we have really talked about day in, day out on matters to do with health? So what you're really saying is that that particular connection has to be brought up, whereby these particular taxes that we are raising are bringing some particular, end goal in terms of the social amenities and the social benefits that we need as a country. Yeah.
Fair enough. Mr. Ngugi, I don't know, because when you talk about taxes being collected and them not, being spent, in a wise manner or prudently for that matter, then it leaves Kenyans with a lot of questions. And let me take you back again to the, issue that you talked about. You talk about mobile phones in your opening statements, and locally assembled mobile phones, manufactured mobile phones. One of the things that is being moved from zero rated to VAT exempt, and there are concerns that that as well will increase the cost of these mobile phones. So at the end of the day, how can the government balance again its priorities in terms of development-wise and stabilizing the economy, but also not overburdening Kenyans and even manufacturing companies, because there are a lot of, the president was heavy on production, manufacturing, but again the business environment is not so conducive, so they say.
Thank you, Ian. If you look at there is misinformation regarding the cost of phone, the current provisions and the proposed provisions. If you look at it, previously you would have 10% excise duty on cost of phone, imported phones. Then you would have rural development levy. Then you would have IDF fees, and that is 2.5 and 2%, that is 4.5%, then 10%. And all these costs have to be loaded for you to have the taxable value of this phone. So if you are to take, for instance, if you take a phone worth 1,000 bob, and you subject the current provisions, you do 10%. You add 10% to that, the cost of that phone. Mm-hmm. That would be roughly, that will be 100 bob for that phone. Then you add that and it will be 1,100. That we are looking now at the current provisions. Then you tax that VAT at 16%. That you are getting 176. So the total cost for that phone would be 1,276. What about the proposed provisions? And that is why we are saying that if you look at the finance bill as a whole, you're going to get that, you're going to see that even if they give on this hand and they take on the other, it has a balancing effect. Because if you look at the current proposed provision, the proposed provisions, it means that then you're going to take the 1,000 bob for the phone, then you add excise duty at 25%, and that will be the cost of the phone. And you see that the cost of that phone in the proposed finance bill, it will be cheaper than the current provisions. And therefore, we need to demystify the misinformation regarding the finance bill.
I don't know, because there's the imported ones and the locally rather assembled ones, because the one that you're talking about is the imported one, which the CS alluded to. All the levies or duties being levied on these imported phones would amount to 55.5%. And they said they're trying to scrap all that and just impose a 25% excess duty on that. But again, there's the issue of the locally assembled or manufactured ones.
Yes, both of them now have been classified together because they're now attracting 25% excess duty. Mm-hmm. But even if you are to look at the local manufactured phones, they will still be cheaper. Thereby now what will happen, they'll be accessible. And you see that a phone is just not a tool, but it's a tool for trade. Then look at also the funds that are being released. When you talk about this VAT these phones being exempted, because there will be a working capital for these businesses. And why they will have extra working capital? Because the excise duty will be paid at the point of activation. Previously, you know that when you're importing a phone, at the point of entry, you're supposed to pay excise duty. So if you are to buy phones worth 100 million, the excise duty on those phones, that was 10% currently, you have to pay upfront. Whether you have that stock or whether you sell that stock or you hold it, you have to pay the excise duty. But right now, you are paying only at the point of activation. Therefore, what it means is that businesses will have more cash flows when it comes to phones, imported phones, and all goods that have been exempted.
Fair enough. Let me come back to you, Mr. Onyango. I mean, when you talk about taxation, and most Kenyans have raised concerns about this particular bill, one of the key concerns by Kenyans out there, almost all the time when it comes to government initiatives, be it about taxation, be it about projects, is the issue of public participation. I don't know from where you sit whether sufficient public participation has been undertaken or is being undertaken, and probably what would it really entail, because sometimes the issue of interpretation about this comes into play.
Yes, thank you so much. I think I should mention also that it is important for our viewers to understand that this bill was presented to the National Assembly on the 5th of this month. This bill is 124 pages long. And so chances are excellent that many Kenyans will not have an opportunity to read this bill entirely. But I think our goal here tonight is to try to inform Kenyans on what are the contents within this bill. Because the contents within this bill is going to affect how Kenyans are going to make calls from 1st of July this year. It is going to affect how Kenyans swipe their cards from 1st of July this year. It is going to affect how Kenyans undertake, or rather go about disputes with the KRA from 1st of July this year. It is going to affect how Kenyans are saving every shilling towards retirement. But now to get back to your question, is the public participation timeline sufficient enough for various stakeholders to, put in their inputs in this particular bill? The short answer is no, and the reason is because if you look at the timeline that has been given and the depth of this document, you realize that there is no sufficient time for Kenyans to interact with it and try to understand it. The document, as I said earlier, has propelled some very progressive proposals, even though we also see some concerning proposals. But generally, the document, for me, it is championing what I would call a smart revenue administration, because we have seen many instances where the proposals are trying to shift, or rather to cover, the taxpayers from the effects of the tax burden. For example, as I wind up, if you look at the proposal on the amendment on Section 39 of the Tax Procedures Act, what it does is that it is extending the tax amnesty period, all right? And it is doing this by shifting the debt cutoff from 31st of December 2023 to 31st of December 2025. What that means is that for all the taxpayers, they have up to 31st of December 2026 to pay any outstanding principal on taxes as at 31st December 2025. And by so doing, all the penalties and interest are going to be waived. So what that means is that all businesses that are drowning on penalties and interest in KRA have a lifeline through this finance bill. So generally, if you look at it from that angle, you realize that there are some clauses or there are some proposals within the bill that are very progressive, and they are geared towards ensuring that the burden is lessened from the taxpayers.
Now, just before we take a brief breather, just for a minute, you talked about it being 124 pages and the timings being a great concern. One would wonder if that can be looked into. But again, when you talk about, for example, there's the issue of one clothes rather, the mitumbas and all that, and there's also a proposal to, of course, bring in a 5% in regards to them being imported. One would assume, how progressive is that? How does that hurt those mitumba sellers in Gikomba, in West in Eldoret? Is that something that you'd say probably will also make the business environment for them harsh? Will it make things more difficult for them? Because at the end of the day, many of them have families, and if there is 5% excess duty on those mitumbas, then it directly affects their businesses.
Well, as I said earlier, you see, there is a concept called smart revenue administration. And what this concept entails is that a smart revenue administration is that administration where the tax framework creates business even as it collects taxes. So if you look at it from this mitumba business, for example, you see that there are incentives that have been given towards the creation of businesses, even though we also see that taxes are being collected. So it is always a win-win. But a fair revenue administration system is that which creates business opportunities and at the same time collects taxes. So for me, when I look at it from the general view, I see a balance between business creation and taxes collection. So for me, it is a smart revenue administration.
Fair enough. We want us to take a brief breath and then come back to that conversation, because I'm having a bit of an issue in trying to understand what you're trying to put across, because you're talking about business creation and it being a smart way to collect or get revenue by the government. Yeah. But at the end of the day, the question would be, how smart is it in terms of, because SMEs have been struggling. Young entrepreneurs have been lamenting about the business environment, and not just local young entrepreneurs or SMEs. Also, investors have been lamenting about the environment of doing business here in the country. But that will be after this brief breather. Do stay with us. Well, many thanks for staying with us. Before we continue this conversation, I want us to listen to what stakeholders had to say yesterday during a public participation session before the National Assembly Finance Committee. And of course, these are stakeholders led by the likes of KEPS and the Kenya Association of Manufacturers.
Taxing digital processing triggers a cascading tax effect that increases transaction costs and the cost of doing business. Furthermore, a withholding proposal explicitly attempts to legislatively reverse the Supreme Court of Kenya's decision, Barclays Bank of Kenya, now EPSA versus the Commissioner of Domestic Tax, because there is precedent.
We must avoid measures that unintentionally will burden for more retail, MSMEs, digital commerce, and already strained households.
We've seen a lot of taxation introduced on inputs. One is the excise duty, and two is the export investment promotion levy. And our proposal is we need to remove taxation on raw materials.
Our packaging material for local manufacturing or pharmaceuticals has an excise duty, and that's what we would want removed.
But invoicing for school fees via items is a logistical nightmare for schools. And so what we were asking was, what we've asked for is to be exempted from invoicing through that.
Fair enough. Mr. Nyanga, let me begin with you just briefly. They've talked about manufacturing industries, and they've talked about the rising cost of raw materials and inputs that they use. And they say that will indeed hurt those industries. You talked about this being a smart move by the government to generate revenue. But if it goes to the point of raw materials, inputs, costing more, then it means that particular cost will be passed to the consumer, which is the normal Kenyan out there. So I struggle to understand how smart that is with the current economic situation.
Yeah, it's not straightforward. Yeah, but I think the point that is coming out there is that some of these products have been zero rated. And what that means is that there is full input VAT claim on those zero rated goods and services. But for the ones that have been exempted, in the manufacturing, the challenge there is that there is no full input VAT claim on those exempted. And so what that happens is, whereas the final consumers will not feel the burden of VAT, but the producers are going to feel the burden of VAT because they are not going to have full input VAT claim on the production, on the input they are putting in producing those goods. So that is a challenge. And the thing is, because they are not able to have full VAT claim on the input, then what they are going to do is that they are going to pass this cost. This cost is going to be passed indirectly to the cost, the final cost of the product. So even though we may not see VAT in the final cost, but indirectly that cost is going to be higher because the producers are trying to cover that cost.
Well, but that again impacts or affects the common man directly with the current economic situation.
Correct. The general effect is that Kenyans are going to feel it. They're going to feel the burden.
Then would you still term it a smart move by the government?
It is smart in the sense that, in one way, actually it is smart in the sense that Kenyans who are not keen enough may not be able to see the VAT impact on that particular on that particular good. But at the end of the day, you can see that it is still being loaded into the actual cost of that good. So yes, what I would say is that there is a sense in which it is creating a business opportunity, but at the same time, it is also, the government is also collecting taxes as a result of that initiative.
Fair enough. Annette, this is for Treasury again, and this is one of the issues that Mr. Nyanga has also alluded to, and we've raised concern about it, the issue of public participation. It has been a short time. Like you said, the document is, it's big, 124 pages. But the CS says they've conducted public participation across all the, counties here in the country. Because also from the feedback, Kenyans are saying they've not been engaged in regards to this particular, finance bill. So how sufficient has been the public participation? And from where you sit as a commission as well, because you are within the Kenya Human Rights Commission, how can the government go about this issue of public participation to ensure that it touches on each and every Kenyan? Because when the CS says they've conducted public participation on across 47 counties, one would raise questions about that, because that is also from the feedback that we're getting.
Thanks. One of the things that makes me happy as a Kenyan is the fact that public participation has been widely provided for in the Constitution. And in the recent times, Kenyans have been awakened to just understand the governance system, to just show interest in engaging in matters public finance, for instance, looking at 2023, 2024, 2025, and even now 2026. What we are grappling with is meaningful public participation. So by people just engaging or by people just showing interest cannot translate into meaningful public participation. And for us to get there, that requires a lot of things. For instance, we've just talked about misinformation and disinformation, and that even starts from the document that was shared in public domain. Right now, we were having a conversation whether there's a 5% tax on mitumba. We just realized that the actual bill that was tabled in Parliament on 5th of this month dropped that. But then there's a document out there that is circulating indicating that that tax exists in the bill, okay? So that alone would not allow for people to engage meaningfully. There are those that are engaging right now, for instance, from the mitumba sector, maybe claiming the government has imposed a tax that perhaps would be undesirable, would perhaps impact on their businesses, yet that is not the case. So for us to say we have gotten to a point where the public has been engaged, it also points to the kind of information that the government, the public is consuming. A good example that I would give, having reviewed different finance bills, this particular one is very complex in nature, leave alone the number of pages that we are talking about. It's taken experts close to 2 weeks to just understand very well what does this bill mean. And you can already see, even from the response from the government, the CS has really come out almost like 3 or 4 times to be able to do clarification. If the bill was very clear, I don't think there was need for the government, for instance, coming out time and again to be able to do this clarification. So it tells you that the bill in itself, it's very complex for Mwananchi to be able to understand. And so for me, for us to get to a level where we are saying that there is meaningful public participation on this particular bill and bills to come, government also needs to invest heavily in ensuring that the common Mwananchi, first of all, understands what the bill is all about, and they're able to get a platform and opportunity for them to be able to engage. Right now, as we are speaking, I think there's not much that the public can do. The ball is in the court of the parliamentarians, who are our representatives, to now make it right in terms of their debate and also approval of the bill. But we cannot say, to be honest, that where we are, Kenyans have gotten it right, that they have been able to meaningfully engage in terms of providing their input and proposals around the finance bill.
Fair enough. Like I said, you're from the Kenya Human Rights Commission. You've talked about Kenyans looking at the National Assembly or their parliamentarians to help them in regards to this. But of course, you are privy to the fact that there are concerns about the National Assembly in itself and whether it is captured by the executive or it is an extension of the executive or not. Then if that is the case, if it is captured or people believe it is an extension of the executive, how then will they be able to represent and ensure the interest and the concerns of the people they represent are well accounted for?
I think the answer lies with both you and I and the Kenyans. And a trend has been seen in this country. Look at the finance bill of 2023. Look at that of 2024. Kenyans had hopes in members of parliament to be able to do that which is right in terms of rejecting punitive finance bill proposals of those particular financial years that we are talking about. But unfortunately, what happened, we saw them heed to the pressure, especially from the executive, by passing the bill, only for Kenyans to now then take their sovereign power back into their hands and go to the streets and say, you know what, if you're not able to represent us, then we are able to do it ourselves. Because again, what does the Constitution say? It says we can exercise our powers directly or indirectly. And directly also means picketing, going to the streets and doing peaceful demonstrations to just demonstrate that perhaps you are disgruntled about a particular position. So I think this time around, perhaps let's hope that the members of parliament are able to well represent Kenyans by making it right and ensuring that there's a balance to cushion Kenyans. And we cannot say that parliamentarians don't live in this country. They do live in this country. It's just about 7 days ago where we saw Kenyans actually take to the street to be able to protest the hike in fuel prices. Because why? This is going to affect them at a personal level. It's affecting their disposable incomes. People are unable to pay transport to work. So they know very well that Kenyans are going through hard economic times. And so it would only be fair that when they're debating this bill, they ensure that the proposals that they are passing are those ones that are in the interest of Kenyans.
Fair enough. Mr. Brand, we talk about empowering young entrepreneurs. We talk about small businesses and ensuring that they have an environment where they can thrive. But can that be the case with the increase in taxes year on year?
Yeah, so when you ask that particular question, it takes me to the question of predictability. And this is one of the things that the government had promised us within the medium-term revenue strategy and also within the national tax policy. Within those two documents, the government had said that we will ensure that there is a predictable tax system in terms of how we introduce taxes. And we even had some promises in terms of, corporate income tax was going to be reduced from 30% to 25%. VAT was going to be reduced from 16% to 14%. Pay as you earn as well. The tax bands ought to be revised up to now. We haven't yet seen that. But some of these particular changes that we are seeing within the finance bill tend to make businesses not feel comfortable in terms of carrying out the businesses that they do on a daily basis. There's a question that you had posed to Brian concerning matters to do with the tax incentives. And one of the things that, as an institute, that is the Institute of Public Finance, we have done very many, a paper on matters to do with tax incentives. And one of the things that we've shown is that the amount of tax incentives that KRA had before we had the medium-term revenue strategy and also the national tax policy was quite exorbitant. It was huge in that context. And therefore, the revisions that we are seeing from zero-rated to exempt or from exempt to vatable were meant to cure that. However, in as much as they were meant to cure that, we have to ask ourselves, the manufacturing sector in and of itself has shrinked. Most of the manufacturing companies have decided to close off and go and start somewhere else. So is it really important for us to continue revising these particular lists of goods that are being zero-rated and some that are being taken to exempt, while the manufacturing sector is being shrinking in that particular context? Then the second thing is with regards to matters to do with tax administration and how businesses ought to relate with the Kenya Revenue Authority. Within the finance bill, we are seeing a proposal to be able to bring in matters to do with pre-populated tax returns. And we're also seeing something with regards to changing the times for filing in terms of our tax assessments from the 6th month, which is usually June for most businesses, to the 4th month, which is usually April in that context. And also on matters to do with businesses, we're also seeing the 60% requirement, whereby now KRA is now going to be imposing or considering the 60% deemed profit as part of profit for businesses where they do not distribute their assets in that context. So when you look at these particular changes that are being brought about, even on matters to do with the interchange fees. These matters where we're talking about, you know, the card payments, the digital payments in and of themselves are affecting businesses. And it's just in 2026 where we also saw some particular matters on, you know, claiming bad debts on matters to do with taxation, where the time period had been reduced to 2 years, but now it has been increased to 3 years. So if we're seeing these recent changes from one finance bill to another finance bill, you can imagine now what that would mean to even small businesses and to large businesses as well, in terms of the cost that they would have to put so that they can be able to comply with these new particular tax measures that are coming in. And therefore, our ask is, even as we're introducing these measures, let us think about the businesses and the predictability in terms of these particular tax systems. Yeah.
Fair enough. Mr. Ngugi, one would wonder, what are the available safeguards to ensure that public money is used in the right way, because that is also a big concern?
We start from public participation, because when you look at when elections are conducted, people elect their representatives. And they have, National Assembly have the role of oversight in terms of how money is spent and also appropriation of those funds. Mm-hmm. So we start from representation. Number two, we're also looking at the control of budget. The control of budget has the responsibility of making sure that the funds are utilized prudently. Then we have the Auditor General, who will be looking at those financial statements at the end of the year. And these reports are also tabled in the Senate, are also tabled in the National Assembly. And therefore, when it comes to safeguards, in terms of the funds collected through this finance bill, there are enough safeguards in our Constitution. And therefore, what the members of the public needs to do is to be aware that, one, representation is key, and also public participation when it comes to matters in Parliament.
Fair enough. You talked about the Auditor General. You've talked about the control of budget. Time and time again, there are reports produced even by the Office of the Auditor General in regards to how money has been spent, where there's questionable expenditure, where billions or millions were, not used wisely per se. But at the end of the day, these cases do not, are not addressed with the seriousness that it deserves. The Office of the Auditor General, they've done their bit. The control of budget has done, their bit. Where is the gap in terms of ensuring that those who misuse these funds are held accountable from where you sit?
Thank you, Ian. Now, if you look at the responsibility of the Auditor General, just to report and either qualify the financial statements and also give a management letter to Parliament. And when that happens, Auditor General does not have prosecutorial powers, and that has to be done by the EACC and the DCI and the Kenya Police.
Exactly my question. So are those agencies the weakest link?
That is the weakest link. Yeah, those are the weakest. These institutions, because once the report is tabled in Parliament, they have the oversight role, and they are supposed to question all these the expenditure that has been spent by various government agencies.
Fair enough. Let me come to you, Brian. You've talked about the interchange, fees, and the whole conversation in regards to withholding a tax on card networks and matters interchange fees. Talk to us about that, and how is that going to affect Kenyans out there?
Yeah, thank you so much, Ian. That's a very interesting proposal, and I think this is one of the most controversial proposals that is currently present in the bill. So what it does is this. It is saying that these interbank fees you pay between one bank and another when you are making a payment using your card, that fees, the bill considers that fees as professional fees. And therefore, withholding tax on that fees is due to the government. Now, that particular proposal is controversial in the sense that it is violating the very decision that was made by the highest court of the land. Last year, the Supreme Court of Kenya gave a decision on ABSA or Barclays, what is famously called the ABSA-Barclays decision. And that decision, what it says is that the interchanges and the charges between cards as you make transactions is not a professional fee. And therefore, the court ruled that withholding tax cannot be charged on that particular fee, on that particular charges, because that is not a professional fee. Now, the bill is trying to introduce a professional fee on intercard, the charges within the card. So what Parliament is trying to do there, if Parliament decides to pass this bill, as that clause as it is that they are trying to overturn the ruling of the court, the Supreme Court, and that, again, in a working rule of law system, that is not supposed to be allowed to happen. And there are so many instances. He has mentioned some. There is another controversial proposal in the bill that speaks to the fact that the National Treasury is proposing to remove the VAT on imports, the offset VAT on imports. What does that imply? That implies that if a taxpayer today has 10 million shillings sitting as confirmed tax credits with the KRA, and they are importing a particular good, and the good is at the port, this taxpayer is expected to pay for this import VAT on cash and then continue waiting on the queue for KRA to go and approve the tax credit of 10 million they have. So what that does is that it is interfering with the working capital management for many businesses, and this is going to curtail the normal operations of the businesses. Another controversial clause that the bill is trying to provide, and he hinted unto it, is the fact that the bill is proposing to reduce the number of months within which taxpayers are supposed to file their income tax returns with the KRA. Currently, taxpayers are given 6 months after the end of financial year to prepare and file their returns with the KRA. The bill is reducing this to 4 months. Now, look at the irony here. KRA has 5 years to audit an income tax returns, and it is limiting you to 4 months to prepare these income tax returns. Now, the asymmetry in that particular proposal is what tries to portray whose interest this bill is trying to serve. So these plus other proposals we have talked about here, we feel that are not friendly to the taxpayer, and they are going to burden the taxpayer. And therefore, as I said earlier, it is important that taxpayers or Kenyans take a pause and reflect on some of these proposals that are that are not progressive to that extent. Thank you.
It's interesting you talked about, the issue of return filing realignment and it being brought to, I believe, April 30th from June 30th. Yeah. But I was speaking to other experts and they say, even if we are bringing it to April 30th, if KRA is not adequately prepared, then there won't be much difference.
Okay, that is true. But look at it. For me, I'm looking at the asymmetry in that proposal. Mm-hmm. KRA has 5 years to audit income tax returns after they have been filed. Mm-hmm. All right? Now, currently, they are giving you 6 months to prepare your income tax returns and file them. Now, they are reducing this period from 6 months to 4 months. But they're not reducing the number of years that they're supposed to take to audit this return. So because of that imbalance, we are saying that there is an asymmetry there. And that asymmetry is a clear indication that this bill, in one way or another, is designed to serve the interest of the National Treasury on the behest of the taxpayers.
Okay, fair enough. Annette, let me come to you. One of the key proposals that the head of state talked about last year was, the issue of pay as you earn, and he talked about those earning 30,000 and below, being exempted and all. But the CS yesterday was talking about that not being included in this particular finance bill. And just to be specific, if you look at the proposals by key stakeholders, for example, the Kenya Bankers Association, they propose at least 5 bands, starting from 10%, that is those earning 30,000, and of course going all the way to 10%, those earning 30,000, and of course 30% to those earning up to 800,000. If you look at ISPAC, they're of course talking about the highest rate going to 28%, of course, rather the top pay rate coming down from 35% to 28%. Now, from where you sit on this issue, especially on those earning 30,000 and below, not paying not getting not paying the pay as you earn. Were we playing politics with that as a commission, for example? Because if we only talk about it, but it is not being implemented, and the CS alluded to it not being in the finance bill, then it simply means we're just talking about it. We're not, walking the talk.
Yeah, thanks. The medium-term strategy also provided for that, that there needs to be a review of the personal income tax bands over time, and that was geared towards just ensuring that salaried Kenyans that are earning, maybe previously we've been talking about 0 to 24,000 being taxed at 10,000, and then there was above that about 8,000 at
25%.
At 25,000, and that increases to 32 onwards. So that is provided for in the medium-term strategy. And again, we saw the pronouncement by the president as well, that was going to be effected immediately. Unfortunately, that did not happen. The CS as well came out to indicate that that was going to be effected. So it was the expectation of Kenyans, especially in these particular times that we are in, that the finance bill of 2026 would then introduce that. So looking at the finance bill that we all have access to, that is missing. The only way we are able to explain this is that, one, that was politics. And number two, that the leadership of the day does not have the interest of the people at heart. Because right now the incomes have really, really shrunk. I mean, look at everything that is happening that we cannot, of course, entirely blame on government. The Middle East crisis, of course, cannot entirely be blamed on government, but then it requires the government to be able, now more than ever, to cushion Kenyans. So it was the expectation of Kenyans that that would happen. And I like the Bankers Association analogy and proposal that they provide, that perhaps when you cushion Kenyans, there'll be about 35,000 if you're able to cushion Kenyans by ensuring that you broaden that tax base, you broaden it, cushion Kenyans, then you'll be able to have a lot of money circulating, because Kenyans will have additional resources that they're able to borrow on, they're able to spend on, and therefore we grow our economy. So they are indicating that in a period of 1 year, yes, the government will have lost a bit of revenues, but then that will grow from what they will have lost this year, which is about 28 billion, to about 33 billion, which is good money, and that will then continue to happen in the subsequent financial years. So I think all we are saying here is that the government would have considered this. I don't know how this would play out, especially now that the bill is already in Parliament to be debated, at what point that this come in, but then it's so unfortunate that we are reviewing a bill that generally has not been able to cushion, especially the salaried Kenyans, who over time understand and know well that they have been overtaxed in this government. So in terms of just securing that balance, an expectation, and rather, or including that particular clause in this particular bill would have been something that would have been really welcomed by many Kenyans, especially those that are salaried.
Fair enough. Daniel, of course, apologies, earlier on referred to you as Brian. When the government comes out and probably introduce new taxes, but they don't take into consideration the plight of struggling Kenyans, like Annette has put it and alluded to, even that particular proposal, this would be the opportune time, because the president talked about it being implemented there and then, and of course one expected rather that it would take a couple of months or so, but that has not been the case. Almost 1 year later. So who can Kenyans turn to in this case? And probably even as you respond to that, one other thing that the Kenya Bankers Association and even ISPAC talked about is of course the personal relief being enhanced to 3,000 from the 2,400. Can you help us make sense of that?
Okay, so since we entered into this government under the bottom-up economic transformative agenda from 2023 all the way right now to 2025, we have seen a number of taxes. We have had a debate on whether they are taxes or not, but we can actually say there's some point of taxes, because when you look at it, we have the payee, of course, and then we also have the Social Health Insurance Fund, which was increased to 2.75%. We also have the NSSF in and of itself, which was increased in that particular context. And especially for us as salaried income earners, we cannot forget the controversial affordable housing levy, which was also introduced within our salaries. And when you look at it in that particular context, it reduces the amount in terms of the disposable income that an individual or us as salaried taxpayers have to take at home. And therefore, looking at the medium-term revenue strategy, being that it was there within the 2023-2024 financial year,
this is the last year of that?
Yes, this is the last year of that MTRS, and we have been waiting. You see, if you keep on promising a child, I'll bring you a sweet, I'll bring you a sweet, tell them I'll bring you a sweet tomorrow, but that sweet never arrives, then the child stops waiting and starts becoming desperate in this particular context. And therefore, what we're just really asking for is that this promise be met. And to whom can we turn to? I think there's still room for our parliamentarians to do something, because even right now when the finance bill is being discussed, perhaps they can bring in an amendment and introduce an amendment with regards to matters to do with the payee tax bands. And at the end of the day, we also have our president in this context. We have seen him make certain declarations, for instance, on matters to do with the fuel levy, on matters to do with VAT. He made a roadside declaration that VAT should be reduced from 16 to 8%. And the following day, within a nutshell, it had already been reduced to 8%. So perhaps he might intervene and perhaps help us reduce this particular pay. But even if he doesn't intervene, I think it's up to the citizens to now create that particular demand and ask their members of parliament and also ask the legislature and the executive and the national treasury to ensure that those pay tax bands are reduced and are revised in one way or another. Yeah.
Fair enough. Let me come to you, Mr. Ngugi. Earlier on, you also talked about, matters of e-mobility. And we're moving into an era where, the green economy is, taking center stage. We have climate change obligations and all. But some of these proposals as well, some argue, because electric bicycles, buses, those are, some of the things that are under the category of, being moved from zero-rated to tax exempt. How will the proposals in this particular bill, affect the e-mobility sector and the green economy in general?
Thank you, Ian. The proposals to move the items from zero-rated or buttable to exempt, especially the relating to energy, that we have the stoves that are used by small households, then we have the motorcycles, we have the bicycles, and then we have the buses. In effect, what that means is that even the lithium batteries, what that means is that we stop relying on the expensive energy like fuel and electricity, and we move to solar power, and then we move to EV, and that's a relief to most of these companies that are operating the transport sector. And therefore, what we need to do as taxpayers or members of the public is there's some decisions that we need to make. For instance, for the transport sector, we know that how many buses are applying in Nairobi, and how can we move those from diesel propelled to EVs, and that will mean that we will have enough cash flows and we create employment. Yeah.
Fair enough. Brian, is there any other way for the government to grow the economy apart from taxation?
Yes, there are very many ways of government growing the economy apart from taxation. And the first one would be to deal with the issue of rule of law. I've always believed that as a country, we are blessed with a lot of resources. But the people that have been put in place to be in control of these resources have never been accountable to the large extent. We have seen a lot of wastage in government, both national government and county governments. A lot of money has been waste in parastatals, in government. If you look at the Auditor General's report, the level of wastage that this country is witnessing at the two forms of government is daunting. And I think if we can find a responsible leadership, and by the way, the tone should start from the top. If you can find a responsible leadership that is keen on doing what is right, that is keen on enhancing integrity, and that has zero tolerance to corruption, then I think some of the things that we are struggling with as a country can be able to be taken care of without necessarily increasing taxes. Yeah, so my short answer to your question is that yes, there are so many ways. One of them is to reduce wastage in government and to ensure that people are held accountable. Everybody that is trying to, be responsible in the level of waste we are seeing is held to account for their actions. Yes.
We talk about accountability every other time, but when it comes to, the rubber hitting the road, accountability seems to be nowhere near the vocabulary, especially of those in positions of power, and the plunder of public resources goes on and on and on. Maybe from just where you sit, what do we need to do? Because at the end of the day, again, we complain as Kenyans, like Annette said, but the buck stops with us in terms of getting leaders who are true to the cause in office. But time and time again, we fall into the same trap of electing the same leaders. So that becomes a big headache. Then it means the country cannot even progress.
Yeah, I think the buck stops with us. Yeah, we need to sit back and reflect and try to reflect on what kind of leadership do we really want. I strongly believe that there are men and women in this country that are of integrity. There are men and women who can stand and do the right thing. But chances are excellent that when these men and women, show interest in these national opportunities, chances are excellent that they'll never be given these opportunities. So for me, I think it is a challenge to you and I and Kenyans at large that we need to reflect and try to see how we can be able to bring in men and women of integrity that have been tested and can withstand the test of good governance and good leadership. It is possible.
Fair enough. And not even as I come to you, there is a Newton Ndoria on X who says, current leadership has two major appetites, increasing taxes plus wastages. Kenyan Malema says, punitive bill, it doesn't take care of Mwananchi, but the rich. Ian Kiptola Gat says, soon things are going to be tougher. There's Ratemo who says, and of course, you'll help us you'll help us understand whether indeed what he says is true or not. He says, penye sijakubaliana na wao hapo kwa amendment of section 47 of the income tax, kupea KRA mamlaka ya kuangalia my M-Pesa balance kama sija file returns, ikuwe inakata tax from my M-Pesa balance without my consent when I'm not employed or earning any income. That one is thuggery, fraudulence of the highest order. I don't know whether there's that particular provision.
No, there's no such provision. If you look at the bill that is tabled in Parliament now,
okay,
the only provision that the Commissioner can assess a taxpayer is based on the information submitted by other taxpayers, especially when you're talking about withholding tax, you're talking about employment income, whereby you are deducted pay as you earn, but the employer is not remitting. So those are the instances. And then we also have the Kenya Revenue Authority Act, Section 5, whereby where there's a whistleblower, and then the commissioner someone volunteers information to the commissioner. Commissioner can use that information to assess that taxpayer. Another instance is where the commissioner inspects goods and realizes that those goods, VAT was not paid during importation, and then that by the time that the commissioner is now auditing your books or reviewing your records, then the commissioner can also assess tax on that. The other issue is where we are talking about sharing information under the Tax Procedures Act, whereby information has to be shared, be it in terms of withholding tax, be it about the e-teams, whereby if you are buying an item or a service, then that taxpayer has to file an e-teams invoice or to prepare an e-teams invoice. So there are no instances in the finance bill or even in the current Tax Procedures Act, that the commissioner can access a taxpayer's data without following the due process. And that also goes to say that there also information about the agency notices, whereby if you look at the social media, they're talking about commissioner can access your bank account without even following the due process. And if you look at the provisions of the Tax Procedures Act, the only instances where the commissioner is empowered by law to access to issue agency notices to collect money. And agency notices is a method whereby the commissioner can access either the money that the customers owes you, or where the banks are holding money on behalf of the taxpayer. Then the commissioner can write to that individual or that party to pay the tax liabilities due to the taxpayer. But the only instances that the commissioner is empowered to do so is, one, if you file your return and you don't pay the tax. So you are the one who have self-assessed and you have a tax liability in your ledger. Okay. Number two is where you have been issued with an assessment, and you fail to file a notice of objection within the prescribed timelines, that is 30 days. The other instance...
Briefly, kindly.
Yeah.
Okay, briefly, just finish.
Yeah. The other instance is when now you don't appeal in the tax appeals tribunal. But for the High Court, that will largely be regulated by the Civil Procedures Act and the Civil Procedure Rules, specifically where you want to apply for stay of the execution.
Fair enough. Thank you. Before engaging it, Brian, you wanted to say something?
Yes. I wanted to make a comment on two things. One is the commissioner-originated assessments. As my brother said, I mean, there's no problem with that. The only challenge I have with that proposal in the bill is that it gives the commissioner the power to assess your income based on the information available to them without giving you an opportunity to make an explanation or to give details of your own transactions. That is the only challenge. Because what it is doing, by the way, and I think for clarity, we need to read it for Kenyans, what the Section 29A, which is being introduced using through the bill, is doing is that it is giving the commissioner the power to assess the income of a person as he may deem necessary. That is the language of that proposal. That based on the available records he has, he can proceed and assess. Now, if you look at the Constitution guarantees what we call Fair Administrative Action Act. It says that you have to give me an opportunity to explain myself. You have to give me an opportunity to give you evidence and records why my particular transactions look in a particular way. So what the National Treasury is doing is they're trying to borrow the current framework in the US. The IRS in the US, for example, has the powers to assess the income of individuals, but those powers have been given what we call procedural guardrails that now stop them from misusing the power. So as it is right now, KRA can wake up today, even before you file your self-assessment and assess you, they say based on the past transactions and the information we have, this is your liability. And that assessment is put in your account without you being given chance to ventilate over them. The other controversial proposal is on the stripping off of the appeals power. Right now, the bill is proposing that while you are in High Court appealing on the tax liability, KRA can freeze your bank account. Actually, it specifically says that KRA is now deleting paragraph E of section 4214 by now having powers to freeze your bank account while you are in High Court appealing and going through the process of the judge deciding on whether you actually owe KRA or not. So I think for me that is very controversial, and that should be relooked. And if that is not relooked, then that is going to expose taxpayers.
Fair enough. I see Mr. Ngugi is shaking his head, but I want us to engage Annette. Annette, one of the concerns here from someone who just texted me is that why does the government keep on increasing taxes despite the high cost of living? Is it that they're out of touch with reality? Is it that they simply don't care at the end of the day?
It's largely misplaced priorities. it's the government living beyond its means. So look at the budget that we are working with, because there needs to be a balance between the finance bill and where the money will go in terms of expenditure. We are currently having a conversation of the budget for 2026-2027, which is approximately 4.8 trillion. That has really grown exponentially from what we had last year. So the question is, why is the budget growing right now? And this then calls for a review of what the government is spending money on. And you'll note in terms of where the money is being spent, it's on borrowing. Borrowing that unfortunately is coming in against the law to be able to support expenditures such as recurrent, to pay salaries, which is against the law. You realize that most of the monies, most of our expenses are towards repayment of the debt, towards salaries, because we have a ballooned wage bill.
In fact, the CS was talking of about almost, I think, 1 trillion. That goes to salaries.
Exactly. Yes, then look at how much we are talking about in terms of collecting. So this definitely is going to still leave us with a deficit of about 1.2 trillion. The question is, where is this money going to come from? The more reason why we are seeing that the government is so quick to be able to make some of the decisions that really are against the wishes of Kenyans in terms of taxing, because they would want to be able to meet the budget deficit, considering that our budget is high. I think it's high time that we start having conversation, especially as Kenyans. Where is the money going? Okay? Because if we are able to narrow down our wage bill, if we are able to stop the reckless borrowing that cannot, the government is unable to point to where the monies are going, because borrowing should go towards development. But unfortunately, all that is missing right now as we speak. So I think the conversation that cannot be missed at this particular point is the balance between the finance bill and also the budget, where the money is going. And I think there's a question that you posed that I thought was very, very important when you ask ourselves, why do we feel helpless as Kenyans that we are unable to do something? We're already in the 2027 electioneering mood right now. And I think this is a very good opportunity for Kenyans to be able to make it right, to be able to go to the ballot and elect leaders that they believe in, leaders that will represent their interest, leaders that will make decisions that are in favor of Kenyans, so that we are able to see accountability, rule of law, we are able to deal with issues to do with impunity, state capture, and all that. So there is a good opportunity for us to be able to make it right as a government. We cannot also say every time and again that, for instance, the current government of the day would tell us we inherited empty coffers. So does inheriting empty coffers mean that you need to go on a borrowing spree that at the end of the day will not benefit Kenyans in any way? Look at the socioeconomic services, look at the education system, look at the health system in the country. Those are the sectors that Kenyans care about, sectors that make them pay taxes in this country because they expect that there'll be returns on those sectors in terms of investment. If that does not happen, then Kenyans feel disgruntled, do not have the motivation to be able to pay the taxes that are being introduced. And it's the more reason that now more than ever, Kenyans are even curious to understand, what does the bill say? Is it going to impact me more or not?
Fair enough. Of course, certainly Kenyans do have the opportunity to change the leaders in place next year, August 2027, because since the 2024 demonstrations over the finance bill, Kenyans have been saying, especially the young generation, Wako Kadi, and of course, we'll wait and see whether indeed that will be the turning point for the country. Daniel, even as we wind up this conversation, when you look at this particular finance bill and the proposals in this particular finance bill, from where you sit, are they economically sustainable?
I would say no, they are not economically sustainable. And especially, as we have kept on saying, especially on how it's going to affect businesses, it's definitely going to affect them from a negative perspective. If you think about a business that imports and uses the interchange fees to be able to make their payments, if you also think about some of the new taxes that are being introduced, especially in the shifts of goods from zero rated to exempt, and still at the same time, we are still finding that Kenyans still do not have enough money within their pockets to be able to purchase and to be able to transact in those particular businesses. So I would say that it is not economically feasible. We really need to rethink in terms of these particular tax measures that we are keeping on bringing on people. And one of the things that we keep on saying is that we also need to look at how we are also setting our revenue targets, because over time, KRA has not been able to meet its revenue targets since I don't want to say time immemorial, but since the past few financial years, KRA has not been able to meet its targets. Yet in every financial year, KRA estimates a growth in terms of its revenue targets. So in that context, we really need to be very, very realistic, because once we are realistic in terms of setting our revenue targets and setting those particular budget ceilings that are brought to the floor of the House, then that's the same time then we'll be able to reduce this particular pressure that we are putting on people on matters to do with the finance bill. Yeah.
Pretty much, Daniel. Ladies and gentlemen, we're winding up this conversation, and there's one thing that the CS for Treasury said. They said in this particular finance bill, they're focusing on the basics of taxation, ensuring equity, fairness, and biggest of all, simplicity. Is that the case, even as you give me your final submission?
Thank you, Ian. Yes, if you look at the finance bill as a whole, you realize that one, by the introduction of the electronic tax invoice management system, that is ETIMS, you're able now to invoice and also have the compare what you have sold against your VAT returns. So making fighting taxes easier for taxpayers. The other issue is about the ongoing amnesty. If you look at it, you'll be releasing a lot of cash flows to the businesses, because if for instance you have penalties, fines, and interest, maybe worth 10 million, and you pay the principal tax, and then those taxes will be waived, then it means that then we are releasing cash flows to the economy. The other issue is the EV. By exempting the EVs or the electronic vehicles, and what we are saying is that the cost of business will lower the cost of business, and because we are not going to procure fuel when you're using the EVs, but that will be only charging through electricity.
Fair enough. Mr. Brown, as you give me your final submissions, you've talked about it being a smart move by the government. I think that will stick in my mind for some time, because just like many other Kenyans, I'm struggling to understand how. Probably, what needs to be striked out of this particular bill from where you sit that you feel is, hurting the common man?
Ian, thank you so much for that question. I think to answer your question, this finance bill is going into full force on 1st of July 2026. That is 35 days from tonight. Mm-hmm. I think Parliament has a responsibility to reject or amend every worrying proposal that is in this bill, as highlighted with us here and some experts outside there. So for me, a good tax system is that system which is efficient, is that system which is fair, is that system which is transparent, and is that system which does not curtail some of the gains that we are making as a country. For example, we have mentioned very controversial bills, proposals like VAT on digital services. We have talked about the card payments, withholding tax. We have talked about commissioner-originated assessments. We have talked about the stripping off of the appeals rights. So all these controversial clauses or ideas or proposals that have been propounded in this bill, I would want to ask our parliamentarians to sit back, reflect on them, and drop them for the interest of the country. Thank you.
Okay.
Yes, thanks. In the spirit of tax fairness, which is a principle of taxation, I think we can see pockets of wealth taxation within the bill, which is a plus, but at the same time, we can also see introduction of exemptions of goods or on items that at the end of the day, if allowed to pass, would be able to be at the detriment of Kenyans, because again, Kenyans and the government, because it will lose revenues and therefore burden the already existing revenue streams, such as the income tax, for instance. A good example we have within the bill a proposal to exempt aircraft parts. So you and I know that whoever has the ability to import aircraft spare parts is not you and me. These are rich people. These are high net worth individuals from where I sit. So therefore exempting would therefore mean that you are allowing them to be able not to pay their fair share of taxes. Then you will go back again and be able to tax the ordinary Kenyans because you need this revenue at the end of the day. There's also the capital gains tax, especially around the real estate investment trust. And so within this bill, there is an exemption also as regards to the transfer of properties, especially in the real, they call it REITs, that's the real estate investment trust. So you have a property, and we know, for instance, when you sell a property, it would attract the stamp duty, it would attract the capital gains tax. So once you purchase a product, for instance, or let's say a good example would be land. Okay. Then after 5 years, you are selling this land. Perhaps you bought it at 1 million, you are selling it at 2 million. That profit actually attracts the capital gains tax. So this bill is actually exempting that. It means the government will lose revenue, and therefore you and I are also not the people who are able to purchase this kind of properties. So this again needs to be looked in. The government should ensure that people pay their fair share of taxes.
Fair enough. Mr. Daniel, as you give us your parting shot, just briefly,
yes.
I beg. There's one more concern. Of course, the Kenya Bankers Association won't carry barred from, of course, demanding tax from the sale of repossessed collateral from, recovered from bad debts. I don't know what you have to say in regards to that. Briefly.
Let me start by answering that question on the question of repossessed debts. We were in the room when actually the Kenya Bankers Association were making that particular submission to the Committee on Finance and National Planning. And I think on our end, we do agree, because when you think about it, when they're selling those particular collaterals and someone has made a particular bad debt, it wouldn't be reasonable to impose a VAT in that context, because they've already incurred a loss in terms of the bad debt that they're gaining, that they are incurring in that context. So imposing an additional VAT would be detrimental to their businesses. But quickly rushing to the two issues that you've talked about, on matters to do with simplicity, personally, I am wondering how simple the tax or the finance bill is. People are still going to courts day in, day out to ask why this particular provision is written in this context.
A different definition of simplicity.
Yeah. Perhaps. And secondly, this question, when we're talking about activation of mobile phones, what does activation mean? So if I sell to you a phone, then that means that that's activation in itself. So will I be required to pay the excise in that context? So it's very, very ambiguous in and of itself. And secondly, on matters to do with fairness, we also say no, the bill is also not fair, because at the end of the day, the low-income earners, our payee promise has not yet been given. However, we're seeing certain exemptions, as Annette has said, on matters to do with the aircraft parts and the exemption on the real estate investment trusts. Thank you.
Pretty much. Thank you very much, Daniel, Annette, Brian, and Moses, for gracing this particular conversation this evening. Of course, many thanks to you for staying with us up to this particular minute. Do enjoy the rest of our programming. And of course, if you're sleeping, good night. Until next time, do have yourself a wonderful night. And like always, God bless.